Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
Hello folks, Fergus Hodgson here. This is the Gold Newsletter Podcast. Thank you so much for joining us. I have Donald Chambers on today to discuss alternative investments, the case for alternative investments, what they are, why they should be part of a portfolio, and he is wonderfully qualified to speak about this. He's a professor emeritus of finance of Lafayette College, and he also works with CAIA or CAIA, which is the Chartered Alternative Investment Analyst Association. And what did you say your position was with them?
I help write the curriculum and the examinations. I'm associate director of the programs. Excellent.
And I assume they've given you the designation in this process.
I was actually in the first class of CAIA recipients, which was about 15 years ago.
Great. Okay. Well, you've come to the right audience. Gold Newsletter. People here are interested, particularly in precious metals, alternatives, even cryptocurrencies. We've been discussing a lot in the last few weeks. Why don't you? I was looking at an article you wrote years ago for the American Institute for Economic Research, where I also do some editorial work, and you had this series on modern portfolio theory. Now, without getting too academic on this audience, why don't you clarify what we mean by modern portfolio theory and how that the definition of alternative investments within that maybe paradigm or within that thinking?
Right. When I think of modern portfolio theory, what I think is the idea that investors ought to assemble the most well-diversified portfolio they can. And by well-diversified portfolio, they mean investing in everything that's reasonably investable, and to do so in proportion to its size. So not only should you buy everything, but it even tells you exactly how much you should buy of everything. So if Apple Computer is 1,000 times bigger than Cray Computer in terms of the market capitalization of the companies, then you should put exactly 1,000 times more of your money in Apple than you do in Cray. So it's an academic exercise, which I like to think of as kind of a starting point for us in constructing a portfolio, that diversification is one of the only true free lunches you're going to find in economic life. And what that means is you can truly reduce your risk without necessarily reducing your return. So diversification is a fantastic thing. But when we talk about modern portfolio theory, we're usually talking about the available assets, and all we think about is the stock market, or maybe the stock market and the bond market, the traditional assets. And alternative assets would be, the way I like to think about it, is that it's any sort of asset that isn't covered when people talk about traditional investments in books and courses. It's those lesser known areas that I find to be valuable to diversify into.
Yes, and many people do, but do you want to make the case as to whether it's for purely diversification reasons that we show interest in these things, or that maybe because they're overlooked, there are more or higher returns available?
Well, everything is relative, and by that I mean I look at the valuations in the equity markets right now with the Dow, the PE ratios of so high and the valuation levels so high and the interest rates so low. And I think that there are attractive alternatives just because the traditional investments are so unattractive right now. Now, when I say that, I still believe that the ordinary investor, and there's exceptions everywhere, but the ordinary U.S. investor, in my opinion, should be considering, somewhere between 10% and 30% alternatives. So no matter how much I argue for alternatives, the ordinary investor oughtn't should be putting 70 to 90% of their money in traditional investments, in my opinion. Now, there's certainly exceptions to that, but as a first cut, I'd think 10 to 30% alternatives.
Well, let's just clarify, because I don't know if people quite will understand that. You mentioned alternatives to the conventional investments. So you mentioned the alternatives include ETFs, hedge funds, real estate, private equity, structured products, and collectibles. What are structured products?
Well, those are the CDOs or collateralized debt obligations that were so much a part of the 2008 financial collapse, those mortgage-backed securities. It's where Wall Street takes a set of good securities, usually mortgages or bonds or loans, and puts them in a big pool. But then instead of having each investor have a pro rata share like you do in a normal mutual fund, the investors become tranched, with the most senior tranches having the first claim to the cash flows, and then the junior tranches having mezzanine tranches having less, and then the junior tranches having the least priority to the claims. So what it does is, just like the capital structure of a regular corporation divides the corporate ownership into senior debt, junior debt, preferred stock, and common stock, a structured product does that with financial securities. So you can take a whole bunch of high-yield bonds or mortgages, put them together, finance them through a structured product, and then sell claims or tranches to them with different levels of safety, which actually has a very valid economic role in our society. But it's not something that the ordinary retail investor is going to want to get involved in, and it's more for institutions.
Many of us may be familiar with discount brokers or certain platforms, but it gets more complicated when you say invest in real estate, for example. Are you meaning actually going out and buy, on a personal level, buying homes, or you mean investing in mutual funds that focus on the real estate market?
Well, that's a key question, and it's an important question. Of course, in the United States, when we think about publicly traded real estate opportunities, we think of real estate investment trust, REITs. And buying a well-diversified REIT index, such as, I have no vested interest in Vanguard, but their exchange-traded fund would be VNQ, Victor, nobody, question mark, VNQ.
Okay, sure.
I'm pretty bad with those. So that's just a great way to access public real estate. And I think accessing public real estate is great through these REITs.
What do you mean by public real estate?
I'm sorry, it's kind of a buzzword that we use. Public real estate would be anything that is publicly regulated by the SEC in a very open way with prospectuses, and is traded on something like the New York Stock Exchange or NASDAQ, or an international equivalent of that. So it's listed securities, and that's what these REITs are, and they're fantastic. But one of the things that we stress in alternative investments is private securities. And when we think of private securities, we think of hedge funds and private equity. Private equity, of course, being shares of companies that are too new to have gone public. They're still being traded privately. The problem with private offerings is that they're not competitively traded, and therefore we don't have the security that we get from buying something publicly traded. Now, what I mean by that
you don't have the liquidity available to you.
You don't have liquidity, absolutely, and that's important. But also, when I buy VNQ, that real estate trust I was talking about,
okay,
I have that's an exchange-traded fund, and there's all sorts of people out there that can not only buy it, they can sell it, and they can short sell it. So I have the confidence that there's, literally hundreds of very, very intelligent people who are pushing that market price towards a value that's appropriate. Now, the good news on that is that I think that I'm probably going to get I hate to use the word fair, but I expect to get a fair price when I buy it. Of course, the bad news is you're not going to get an extraordinarily good price either. Now, the opposite is true in the private markets. When we start to talk about private real estate, whether it's limited partnerships that brokerage firms often push, which have a very bad history. I remember back in the 1980s where the deals were put together and they were disastrous.
What are these limited partnerships in real estate?
Well, a limited partnership is a form of business organization that's conducive to having a deal where the originators of the deal serve as the general partners, and then the passive investors, you and me, trying to put some money into a good investment, we are the limited partners. And so those private, that's what most hedge funds are organized with, and private equity is organized along the lines of limited partnerships. And I would urge your listeners to be very, very cautious about getting involved in these deals. We don't, unlike these publicly traded securities, we don't have that confidence that they're properly priced. And I'm the sort of guy who reads the offering memorandums on these deals and really looks at the nuts and bolts, and I have an undergraduate degree in accounting, and they are so often so incredibly skewed against the limited partner that it's ridiculous. And I'm not talking about the big institutional deals that Harvard and Yale and Princeton get to invest in, but I'm talking about the ones that come down and are being pushed by brokerage firms. They're often just devastatingly skewed against the limited partner.
You mean it skewed against the passive investors?
Yes.
That doesn't surprise me. As you said, yeah, there's just less transparency in those arrangements. And so you really do advocate, even if the potential for the uptick is less in the ETF approach, you just think that's a smarter way to go because there's so much less risk involved.
Yes, but there's so much less opportunity, so it's always that painful trade-off.
And you mentioned there that people can get involved in these alternative real estate approaches, aside from going out and actually directly buying homes or commercial properties themselves, that there are what other private equity arrangements and avenues are there available?
Well, for private, the terms we have to be careful here with the real estate, private equity, and then real assets we could talk about. And I don't know which one of those you wanted me to focus on now.
All three are fine. I was getting a bit muddled there because a lot of this is still new to me, to be frank.
Yep. Private equity is the sort of thing where most of it is venture capital, where we're trying to start new businesses, and we hear about businesses like Facebook going public and making billions of dollars for the private equity investors, or leveraged buyouts where you reorganize companies, and it's a very important part of our economy, and most of it is funded by institutional investors with endowments like Princeton and Harvard and Yale investing billions of dollars. It's very hard for individuals to access that.
Why can't they access private equity?
Well, we're too small for them to want to fool with us, to be perfectly honest. What happens is private equity firms, which is an organization like CAIA, that we hear about in these deals, they look for investors, and they serve as the general partner, and then they want limited partners, but they don't want to fool with people who are investing $10,000 or $50,000. They're looking for people who are investing millions. So it's really an institutional market. So when we go in on private equity, which is such a great sounding sector of the market, and then we switch over to the retail level, there's very few easy ways to access it. One thing you can do is actually invest in private equity firms. There's a few private equity firms that are traded on the New York Stock Exchange, but I don't think that's a very good way to access private equity.
Why not?
I think that the price already reflects the liquidity and the advantages of it, so I don't think you're going to get exceptional returns at all, and I don't think the returns are going to be as correlated with private equity as they are with simply the general stock market.
I see.
Then there are some closed-end funds or similar organizations called business development companies, and I've played with a few of those. I shouldn't say play, managed money in a few of those, and they've been a little bit disappointing. And it's very hard for the retail investor to find to develop a reasonably well diversified portfolio of private equity. So I almost think that, with a few exceptions, that has to be taken off of the ordinary retail investors.
Do you want to rub elbows with the best minds in the precious metals and mining industry? You can on the Money, Metals, and Mining Cruise from May 28th to June 7th, 2018. Explore the jewels of the Mediterranean while discovering the latest strategies to successfully invest in precious metals and mining stocks. It's a perfect blend of adventure, learning, and luxurious leisure aboard the Crystal Serenity, always a popular destination. Cabins will sell out fast. Call cruise experts at 800-797-9519 to learn more, or visit our website, goldnewsletter.com/cruise.
What's gone wrong with these business development companies or BDCs?
To be honest with you, I don't think they're run by very good, very competent people. They tend to be poorly diversified, and I just don't think they have the skill of some of the private equity firms. There are maybe some exceptions, but I'm afraid to have people get too involved in that. Now, in some of the other in some of the other alternative areas, I think there are opportunities of where you can diversify. We talked about...
Of the three categories you mentioned, private equity, real estate, and what was the third one?
Real assets.
Real assets, so commodities or real assets. Okay, sure. So what did we miss in the real estate section?
Well, in the real estate, I think the REITs are great. People might even want to look at foreign REITs. I talked about VNQ, and once again, I'm not just trying to push Vanguard, but they're kind of standards to talk about. The fund ETF that somebody might want to look at is VNQI, and I should say that I do manage money, and that my clients have those, but I'm certainly not bringing them up because of that. And I have positions in those funds as well. I should disclose that. It's only the right thing to do. So VNQI, and I'm not recommending these things as buys, but it's the sort of thing that you could look at to understand the sort of risk exposures and return possibilities that I'm talking about. I'm just using them for illustrative purposes. I'm not recommending them. So that's another way to invest in real estate. And for a person who really has a long-term time horizon, and frankly is rather shrewd and to do private real estate deals as something as simple as buying up some real estate tax claims or providing some local financing for some real estate deals with some people that you can rely on. I mean, if I were 25 years old and wanted to build a future, I might actually look into those sorts of private deals. And when I was young, by the way, I did buy rental properties. And I found out that I'm not good at working with tenants. I was very good at buying properties, but they wouldn't make the rent payments, and I'd say, "Oh, okay, I'll wait a week or two." And apparently that didn't work very well. So, real assets is another category, and real assets is this idea that instead of buying something like Google, which has almost no buildings, or Facebook, I should say, that has almost no tangible equipment and buildings, it's almost all just intellectual property. Real assets is the other end of the spectrum, which is you're buying land and farmland and timber and oil and gas deposits and and commodities. And in the category of real assets, I think that the best opportunity I would bring up would be MLPs. Now, MLPs, of course, have been beat up pretty badly when oil prices fell so much a few years ago. But I think it's a huge sector, and it's a sector that people should diversify into. So I would recommend MLP stands for Master Limited Partnerships. They're limited partnerships, but they're publicly traded, so they have a lot of accountability. And the way that I would try to get exposure to MLPs that I try to do for myself is I buy not exchange-traded funds, but exchange-traded notes. And there's an important difference. If you buy MLPs directly or even through an ETF, you begin to run into some tax complications. The tax complications can occur if you put it in IRAs, because you get into this business income issue, or it can happen if you hold too many of them outside of an IRA, because you're supposed to pay state income taxes. So the way to get around that is to invest in an exchange-traded notes. There's a few. I think one of them has a ticker symbol of AMU, and that's something that some of my clients hold and I hold, and I'm not trying to recommend it. It's just there's about 2 or 3 of these exchange-traded notes. You don't want them to be inverse or levered, just pure and simple exchange-traded notes on MLPs. And I think that what that does is it diversifies you into oil and gas, especially the natural gas pipeline systems and what's middle companies. So I think that's something that people should look into as a way to get pretty good yields. It's risky though, and when oil prices or natural gas prices collapse, those things collapse. And I wouldn't try to pick an individual MLP. As I was talking about, you want to do an exchange-traded note, which is like a mutual fund of many of those MLPs.
One thing that has struck me now that I've been covering gold or following it more closely is the way that the gold or the mining ETFs have just struggled so much in recent years. And so, do you want to give a comment on why the mining sector is or is not somewhere you want to place your interest?
Well, I think that when you invest in a broad portfolio of common stocks, you get a decent amount of mining exposure. But whether it's gold or Alcoa with aluminum, I mean, these are tough industries. I happen to not be very bullish on commodities. There's a famous bet that I'd urge your listeners to look up on Wikipedia, for instance. It's called the Ehrlichman-Simon wager years ago, where this Stanford professor who's always claiming there's going to be gloom and doom, he wrote a book about the population explosion and made ridiculous forecasts that didn't come true. Well, he was busy forecasting that commodity prices were going to go through the roof because we couldn't possibly supply the burgeoning population of the world with commodities. And this business professor, Simon from University of Maryland, did a public wager with him and said, pick any 5, I think it was, commodities that you want, and we'll bet to see something like, 10 years later, whether the commodity prices have gone up or down relative to inflation. And Simon won the wager because what we see through time is that commodity prices, inflation adjusted, tend to fall. So I'm not I personally don't hold and don't recommend commodity holdings. And I respect the gold newsletter and the
gold bugs.
I respect gold bugs, but I'm not one. And I think people in the long run have done an awful lot better in other assets.
Yeah, the predicament there is the motivation, because actually physical possession of gold or precious metals is really a protection of your assets as opposed to an investment in productive capital.
I agree. If you're going to own gold, you want it as a asset of refuge, and the last thing you want is a piece of paper that somebody's holding it for you in Manhattan somewhere. You hold it, and I understand that that's a way to protect yourself in worst case scenarios. I really get that.
In the ETF I mentioned, I just brought it up as the GDXJ, Vector's Junior Gold Miners ETF, and my own view on this is that, and this is why we actually have the New Orleans conference, so that people can actually do the research, because it's a fact that the vast majority of these mining companies struggle to become profitable. So you have to be very discriminatory about how you go about selecting them. Right now, you are the curriculum director, or you work on the curriculum for the CAIA, the Chartered Alternative Investment Analyst, but you are promoting your next book with the CFA Institute as well. So why don't you tell people your next book, which is on alternative investing?
Well, thank you. And it would be a good way. It's very institutional, but I still think it gives a relevant view even to ordinary investors. It's going to be published with the CFA Institute. I believe it's going to be free if you go to their website. I think they make these things available free, electronic copies, and it should be available in May. And it's called I'm the lead author. Look for that name, Donald Chambers. I believe the name is still going to be a primer for alternative investments, and it's like an introduction for people that are managing a portfolio of alternative investments, and that should be available electronically for free in about 3 months.
Excellent. Okay, a primer for alternative investments. Is there any other way that people should follow you? I guess going to CAIA and just studying or working through that professional designation. But I know you are retired from teaching. Are you doing any other maybe blogging or other work?
I have done a little bit. I have written a little book you can find on Amazon called Freedom First, which is kind of a collection of readings that is how, from a very libertarian or conservative perspective, I talk about how economies work and kind of some of the insanity that I see going in the world and in the college communities right now. So I would, invite that, and there's some financial insight in those in that book of readings as well. It's available on Kindle for only 99 cents. So.
Actually, I have seen this book, Freedom First: Brief Readings on Liberty, Peace, and Prosperity, reviewed by my colleague Paz Gomes. She gave a headline of "Socialist Millennials Meet Their Match." So that was really a positive one. I didn't make the connection there, but no. So, folks, always go to goldnewsletter.com/podcast for all these details on the work of Donald Chambers and alternative investments. Donald, what a pleasure to speak with you. Thank you so much for your time.
Fergus, it's been great, and I'm so thankful we have people like you helping to spread good, solid investment information. We need that.